Hey everyone, and welcome. Today, we're going to tackle one of the most important ideas in all of finance, valuation. We're going to figure out how investors decide what a business is actually worth and why that number is so often completely different from its flashy stock price. Let's dive right in.
You know, we see stock prices on our screens every single second, blinking up, blinking down, but is that ticker price what a company is truly worth? Well, most of the time, the answer is a big, fat no. There's a world of difference between the market's daily mood swings and a company's real fundamental value.
And you know who said it best? The man himself, Warren Buffett. This quote, "It's everything. It's really the foundation of smart investing. It separates just, buying a stock ticker from actually investing in a business." And our mission today is to figure out exactly how to find that value he's talking about.
Okay, so let's really hammer this point home. Understanding why price and value are two totally different things, well, that's the entire reason the field of valuation even exists in the first place.
Here's another brilliant way to think about it, this time from the legendary investor Seth Klarman. Price is all about emotion, right? It's fear, it's greed, it's whoever is freaking out the most on any given day. But value is rooted in the real stuff, the tangible things a business actually has and produces, like its cash and its assets. It's about the engine itself, not all the noise happening around it.
So here's a simple way to break it down. Price is out there for everyone to see. It's set by the market, and man, it changes every second. Value, on the other hand, is your own educated guess that you get to after doing your homework, and it's way more stable because it's tied to the business itself, not just the market's crazy whims.
So, the big question, if price isn't the real value, how in the world do we find it? Well, good analysts don't just use one method. They've got a whole toolkit. It's kind of like looking at a business through three completely different lenses to get the full picture.
And these are the big three. First, you can figure out its value based on all the cash it's going to make in the future. We call that intrinsic value. Second, you can just compare it to what similar companies are selling for right now. That's relative valuation. Or third, you could try to figure out what it would cost to build the whole thing from scratch. Now, for us as investors, those first two are really the most important, so that's where we're going to focus our energy.
All right, let's start with what a lot of people consider the purest, the gold standard of valuation, figuring out what all the cash a business will ever produce is worth to you today. The idea here is actually pretty simple. At the end of the day, a business is only worth the cash it can give back to its owners. I love the fruit tree analogy for this. You don't value the tree based on what someone will pay for it today. You value it based on all the fruit it's going to produce for years to come. And you recognize that a fruit you get next year is worth a little less than one you get today. That right there is the soul of intrinsic valuation.
Now, even within this approach, you've got a couple of different paths. The dividend discount model is one. It only looks at the cash that's actually handed out to shareholders as dividends. This works awesome for big, stable, mature companies. But what about a super high-growth company like Google's parent, Alphabet, that has never paid a single dividend? For a company like that, we use free cash flow models. They value all the cash the business generates, whether it's paid out or, more importantly, plowed back into the company to fuel more growth.
Okay, let's be real. Predicting the future is, well, it's hard. So what's another way to get a handle on a company's value? Simple. You look around and see what people are paying for similar stuff right now.
Think about buying a house. It's the most natural thing in the world, right? You would never, ever make an offer without first checking what the other houses on the block have sold for. Relative valuation is just applying that exact same common sense to the stock market. It's less about finding some perfect, absolute number and more about judging if a stock is cheap or expensive compared to its neighbors.
And the most famous tool for doing this, the one you hear about all the time, is the P/E ratio. It's a simple question. How many dollars are you willing to pay in stock price for every $1 the company earns in a year? So if a stock is $20 and it earns $1 per share, it's got a PE of 20. It's just a quick and dirty shortcut for cheapness.
Okay, pop quiz. Let's look at this. We've got two companies, A and B. They both earn 10 rupees per share, but company A trades at a PE of 12, while company B is at 14. Looking just at this, company A seems like the no-brainer, right? You're paying less for the exact same amount of earnings. Easy decision.
But hang on a second. This is where simple numbers can really trip you up. A higher price tag might be totally worth it if that company's earnings are about to take off like a rocket. So what if you're just paying a little bit more for a whole lot more future growth?
This is exactly the problem that the legendary investor Peter Lynch wanted to solve. So he helped popularize the PEG ratio. It's brilliant. It just takes that PE ratio and divides it by the company's growth rate. All of a sudden, you can compare a slow-growing company to a fast-growing one on a level playing field. And a good rule of thumb is that a PEG ratio under 1 often means you're getting a pretty fair price for that growth.
So now, let's go back to our example and look at the real picture. Whoa, the whole story just flipped upside down. Company A, our cheaper stock, has a PEG of 1.2. But Company B, with its higher PE but much faster growth, its PEG is just 0.93. And just like that, the more expensive stock is suddenly looking like the real bargain here. So we've got these incredible tools, right? Intrinsic value, relative value. But, and this is a really, really big but, it's so important to remember that this isn't about finding a single perfect magical number.
I love this thought because it gets right to the heart of the matter. Any valuation model, I don't care how complicated your spreadsheet is built on a foundation of assumptions. Assumptions about the future, about growth, about risk. It can give you this false sense of being exact, but at the end of the day, valuation will always be an educated estimate. It's an art that just happens to use science as its paintbrush.
And because it's an art, you've got to dig deeper. For example, you see a low PE and you think, great, that's cheap. But what if that company is drowning in a mountain of debt? It's also critical to look at stuff like return on equity, or ROE, which tells you how good a company is at using your money to make more money. And hey, if a company isn't earning much right now, its simple book value, what its physical stuff is worth, suddenly becomes a lot more important. And you've got to know who you're measuring for. ROE is the return for shareholders, but ROCE, return on capital employed, that shows the return for everyone with skin in the game, including lenders. It's all about asking those deeper questions to get the full story.
So let's end with this. Knowing that every stock's value isn't a hard fact, but really just a well-reasoned story about the future, an educated guess, how does that change the way you feel when you hear someone on TV screaming that a stock is cheap or expensive? It's a huge shift in mindset, isn't it? You go from just reacting to a price to actually thinking about value. Thanks so much for joining us.